What's up, guys? Mike Sharp here. This is Sharp Investing, and I'm going to talk about DLocal today. DLocal has the potential to be a huge runaway winner over the long term. They have a very sticky toll booth business, and I will get into it right away. So DLocal is basically, if you want to look at it as a mix between something like Adyen and Stripe and Wise, right? So the Adyen and Stripe side, they are a payments gateway, processor, and acquirer in emerging markets. So they focused on emerging markets. Stripe and Adyen are focused on developed markets. They do have operations in emerging markets, but their bread and butter is in all the developed markets, right? And then so Wise, if you don't know what Wise does, they facilitate cross-border transactions very cheaply for individuals and businesses, mostly focused on individuals at the moment, but could get into more into the business side. Also great businesses you might want to check out if you're interested. So they facilitate local payments as well as cross-border payments for large entities. Think Amazon, Temu, Uber, Netflix. These are all their customers, and there's a huge list of very big companies, and that shows you that they must have a pretty good offering, or some of those companies would just build their own payments system, right? So the big key offering that they have is because they've opened up in 40 plus, they don't give you the number, but between 40 and 50 emerging markets countries, these countries have a lot of complexity on the payment side, right? If you go to Brazil, there's multiple payments. It's not just Visa, MasterCard everywhere. There's Pix, Boleto. A lot of people use cash. There's a whole bunch of other ways to pay, right? So the thing is, these big companies, like let's use Amazon as an example, they come into, typically what happens is they come into these countries like Brazil. If they're going to go to emerging markets, they'll go to Brazil first, and they'll just take international payments. The problem with that is you're going to lose maybe up to 50% of your transactions because a lot of people don't have Visa and MasterCard, right? So then it becomes a problem. And then you have to go through this whole regulatory process to get all these other, and all this licensing to get all the different payments on. So what DLocal does is they say, we've got 900 plus payments methods set up across all these emerging markets. All you do is plug into our one API, and you can take all those payments instantly. You can ride on our back for the licensing and the regulations, and you can just start getting paid, right? So if you buy something on Amazon in Brazil, it'll go through to a DLocal payments gateway, and it gets processed there. So that is their offering. And then what they do is they say that they start at the start of the S curve with these big companies. And like I said, a lot of them will go to the bigger markets first, like Brazil is a pretty common one, or Mexico, and they'll start there and they'll get set up, and then they'll go to other markets like Argentina or Colombia or whatever, right? Egypt, something like that. And basically they can go through that process with DLocal, who's already set up. And the other advantage, if you're one of these companies, is DLocal is becoming bigger over time, and they can negotiate better fees, processing fees, and interchange fees, and all that stuff in the back because they represent all these companies over all of these markets, right? So they can negotiate better fees. It lowers the cost for their customers. The customers get a lower price, and it starts creating one of those Nick Sleep scaled economies shared models where it's very tough to attack them because they're becoming lower and lower priced. And there's also this sort of switching cost mode, right? Once you're set up, if the costs are low and you're set up and everything's working fine, there's not a lot of benefit to changing your payment processor, right? Now, Stripe and Adyen can come in. They're big, well-capitalized companies. They're much bigger than DLO overall, and they could come in and start a price war. But as you'll see later, there is probably enough to eat for everybody here. There's a massive and growing TAM, and it's totally untapped. Not totally, but it's mostly untapped at this point. So basically, the business model is their complexity is the barrier in emerging markets because it's just a total mess. Like if you're trying to set up with all these payments, and they simplify that for for these big companies, right? And then DLO, what they can do is they actually try and sell these companies on going to the other countries, right? So that's part of their sales process. As an example, some of the businesses they work with: Amazon, Temu, Shopify, Uber, Didi, Netflix, Spotify, Google, Microsoft, Meta. Like these are the big companies, right? And so for me, that really shows that they've got to have something quite special if they're able to retain all those massive clients. There is a downside. I'll put it in the risks. 62% of their sales come from their top 10 customers. So there is a customer concentration risk there when you're dealing with these massive businesses. Okay, so let's just look quickly over the DLO versus no DLO model, right? So let's say you're setting up, you need 20 new contracts with 20 different banks and processors. You've got to set up local legal entities in each country, and then cross-border payments lead to low authorization rates and high fees. So that's the wise part that I haven't talked about yet. And then if you work with DLO, you only need one contract with DLO. You don't have to deal with all the crap, and you can focus on your business, right? Rather than licensing and regulation and contracting, all that stuff. They also have a system called smart routing. So they have all these different payment methods and different they got all the pipes set up, right? So what they do is they'll route the payment through the cheapest, most efficient path for the vendor, and then again, lower price, feeding into that scaled economies shared model. So let's talk about the Wise side. If you haven't used Wise, I love Wise, by the way. I have like 3 accounts already where I use it for work and all this stuff. But basically what they've done is they've really thrown a wrench in the banking sector by allowing cross-border transactions and cross-currency transactions very cheap, right? And so what they do is, let's say I have a company in Australia and I want to send money to Canada where I am. They don't actually send the money across. They've got pools of capital in each country. So they just say, okay, you put the money into Australia, we'll pay you out of our Canadian bank account into your Canadian account. So they're not actually transacting money. And what they can do is offer very extremely low FX rates, like 80%, sometimes more, lower than what the banks will charge me. Like I've saved so much money by using them with my business. It's crazy. And DLO has the same idea. As they get bigger and they have these bigger pools of capital in all these countries, they can transfer money for their customers very cheaply, right? So let's go back to our example where you start in Brazil and then you want to expand to Argentina. You say, okay, money's coming in Brazil. I want money out in Argentina. You go through DLO, say I want to transfer $1 million, what do they call reais? $1 million reais to Argentina. They say, okay, and then they pay out of their Argentinian peso account, and you get the best rates in the biz, right? And particularly when you're talking about these emerging markets, like if you're sending money from the US to the euro, like the spreads are really tight because there's so much competition, there's so much volume and so much competition that the cost of doing that transaction is not that high. In the emerging markets, it's way higher. The spreads are way bigger. The rake is way bigger for the banks. And this potentially can save a lot of money for the customers, which again builds that moat and builds that flywheel scaled economies shared thing. So there's 3 growth vectors here that they talk about. And the first one is extremely important. It's probably the biggest one. There's very low digital penetration in the emerging markets. There's a lot of cash. There's a lot of other payment methods. And essentially this is a war on cash, right? I've seen, if you watch other videos I have, that's the Stone Co thesis, right? It was a land grab in Brazil and everybody was able to grow really fast because they were getting away from cash. The government was trying to get them onto PIX, and they've really done a great job in Brazil to get away from cash, and it had this massive tailwind for all these companies in Brazil. Other emerging markets aren't that far along, right? There's still a very low rate. It could be like from 50 to 90%, 95% cash, right? Versus developed markets, which is more like 10 to 40%, right? So there's a huge amount that can still move, and they can, like I was saying before, there's probably enough to eat for everybody, right? Like even if Adyen and Stripe went really strong into these markets, there's room for everybody to still grow very fast. So the second growth vector is the share of wallet with the merchants. right? And so that happens by growing with them to these new emerging markets. Like they say, they want to start at the beginning of the S-curve, and as these companies go to more and more countries, they're along for the ride, right? So they're growing based on their customers' growth, right? They don't even need to do more sales. The customer is growing for them. So that's a really nice tailwind to have when you get in early, right? And then the third vector is obviously new merchants. They want to get more people on the platform. And that's this traditional way you grow your business, right? So let me go through some key points here, and then I'll do some real shot in the dark projections afterwards. But the first thing I would mention here is that this is going to be a wild ride. Like if you go back and start researching this, you'll see these massive earnings gaps that happen multiple times, right? They release earnings and it's down 20%, or it's up, like the last one, I think they were up 30% on earnings. And that's because when you deal with emerging markets, there's a whole bunch of stuff that can happen, right? I just went back 4 years, I think, and there was at least one major devaluation, currency devaluation in one of their markets every year, right? And I think 2024 was, they had two, I believe, or maybe it was 23. Anyway, there's like, this stuff's going to keep happening. And, so when you're dealing with emerging markets, it's going to be crazy. So we, as investors and strategic buyers, we can take advantage of that and wait to try and find opportunities where there's where the business is good, but the external environment is hurting them, like in one of these devaluations. Now, I should also say that they're somewhat diversified away from that risk, because when you're dealing with, let's say, 45 different countries, they're not all going to devalue at the same time, right? So even if you have two, you still have 43 that aren't. And so unless it's one of the big ones, which actually was, they had Argentina, they were in Argentina when that went down, like that hurt them. But as you'll see, like the TPV just keeps on growing at massive rates. So another key point is this would be the catalyst. So they're saying that their heavy software investment cycle is actually coming to an end this year in 2025, which will increase the profit margins once they scale back this investment, right? So the number that they look at here is gross profit to EBITDA margin, or EBITDA to gross margin, the other way around. And it dropped to like low 60s in 2024, which is one of the things that scared the market. But I think that was a temporary problem. And now it's back up to 70%. And they believe it's going to go back up to 75% in not too long, right? So if you want to model that out, you'll see that the earnings are going to grow pretty fast, and that is very high operating leverage. Now, I want to talk about revenue versus gross profit. Now, one of the and take rate as well. So their take rate they talk about is actually of gross profit, right? It's not of revenue, because they believe, and I believe, that the gross margin is actually the more important number. So what's happening is, over time, when you're dealing with these big vendors, they know that they have negotiating strength, right? If you're dealing with Amazon, you want to keep Amazon. They know it. They can press you down on your take rate, right? So what's happening is the gross margin is shrinking over time, right? Because their big vendors are pressing down, and they even say this is going to continue, right? So we have to expect that the take rate from revenue to gross profit, the gross profit margin, is going to decline over time, and that's fine. That's what's supposed to happen, right? As long as the TPV is growing very fast, then that's irrelevant to us. So we have to keep an eye on gross profit. So is the gross profit growing at a reasonable rate? If it's not, then that's a major red flag. But right now it's growing very fast. One big tailwind here is just generally emerging markets, right? They have a much younger population base, and it's growing a lot faster than the Western world or the developed world. And as you probably know, Western countries have population decline, right? We're aging population, and the issue with that, well, one of the issues with that is old people don't spend as much money, right? Whereas if you've got young people in the system, their earnings are going up and their spending is going up. So what this is going to lead to is a mismatch or a big imbalance in the growth, global growth over the next 10 years. So it's forecasted that emerging markets are going to grow at 4% on average, whereas developed markets are going to grow at 1.5%, right? And that the growth in the entire world, percentage of global growth going to emerging markets is going to be 65%. Like, these are just projections, but I think directionally it's correct, right? Over the next 10 years, emerging markets are going to be the place to be, as long as you can handle the crazy ride, because it's not going to do this, it's going to do this, right? So we've got to be strategic and buy on some of these, if that makes sense. Okay, and here's the big one. The TAM for this this business is in the trillions. Right now it's 2.1. They're forecasting it's going to double in 5 years to over 4 trillion. And this is the reason why there's so much growth available. They're currently growing their TPV at 50%, which is huge. And so there's a massive amount of runway left. So even if they didn't take market share, they're going to be taken up in this this giant wave. But they are taking market share, so there's a double win that's happening. And if it keeps going, this is why you could see this being a multi-bagger in if you give it a 5 or 10 year window, maybe even less, right? Okay, so Pedro Arnt, I'm not going to talk much about Pedro, but it's worth noting that he was the CFO of Melli. So he is definitely an asset, right? He knows this space really well. Melli is one of the winners in the emerging markets, payments and e-commerce space, and it's a phenomenal business if you haven't looked at it yet. But so this guy has a great background, and I don't have a huge view on him yet, but I think his background speaks for itself. I'll just quickly go over the scaled economies shared key points again. I've said them already, but it's worth reiterating. So they can negotiate better processing rates on behalf of their merchants as they get bigger. Local acquiring and processing fees, cross-border fees, conversion and FX fees, like I was talking about, the WISE model, and interchange fees. So as they get bigger, the pricing power gets better and the moat gets bigger, right? So this is an emerging moat, right? If they get over the hump where they're become a gorilla in the market, I don't think there's going to be any way to dislodge them. I don't think they're there yet, though. It's actually not a huge business as of yet, but they're on the way. Now I want to talk about the risks or the issues out there, right? So this isn't without its share of concerns. So the number one for me is actually the capital allocation. Despite Pedro being the CFO of Melli, they've done something that I don't think makes a lot of sense from a shareholder or from me as a shareholder perspective. Last year, they paid out a dividend of 51 cents, and this was while the stock was trading at 11 bucks. To my mind, if they know the growth prospects are this big, they should be buying back the shares while the shares are depressed, instead of paying a one-off dividend that releases capital from the business. Now, I think my guess is on what's happened here is the founders just wanted a payday. They've done well. They built the business, so maybe they just wanted some cash. Sergio Kaplan owns 17% of the business, and Andres Bay owns 16%. So these are the founders, and fair enough. Maybe they just wanted the payday. The issue I have that's bigger is actually there's an ongoing dividend of 30% of free cash flow ongoing, right? And they've already committed to that, which I think is a problem. I think that if it was me, I would say we'll return 30% of the capital a year, and we'll do it strategically in buybacks or dividends, whichever one makes sense. But they seems like they've locked themselves into that. Maybe the idea is to stabilize the stock price a bit because it's been pretty wild. If you have a stable dividend, it will reduce some of those peaks and troughs. Maybe that's the idea. I don't really know. Now, currency is another major problem here, right? I talked about it previously. There's always going to be devaluations, which are going to hit revenues, gross margins. They're still growing at 50%, even with the devaluations. But there's situations where you could get a whole bunch at once. That could be a real problem. But the bigger problem on a short-term basis is the US dollar specifically. If the US dollar goes up, everything else is down against it, right? You're going to get them all down. And the problem is they report in US dollars. And so it's going to, it would eventually, or it would end up crushing the growth rates and the optics of the business. Now they'll report constant currency terms, but I think that's total crap, right? Like I'm not interested in constant currency terms, but the US dollar can hammer this company in shorter. Now, and I think the US dollar is going down overall because that's what Trump wants, and Trump gets what he wants. I do think there's probably a short to medium term tailwind on emerging markets currencies because if we have a boom in the US based on the US dollar going down and US rates going down, that's really going to benefit companies like this. And that's part of the reason why I'm in this one, because I want to be along for that ride. Now, it should be said, I do have a stop in on this one, right? Because there are certain situations where I don't want to be in this company, right? I don't want to be in here if the S&P and the NASDAQ roll over and they start going into a bear market, right? Because the things that are going to get killed the most are emerging markets, right? Well, and also all the crap that people are buying, Oklo and IONC and all this weird stuff. But the emerging markets, people are just going to dump them, right? And so I have, in that case, I'll be just stopped out. I bought around 14, low 14s, and the stop is in the 12s. I can't remember the numbers right now, but it's sort of like a strategically, okay, if the price goes there, then it means it's broken down. If it does that just based on an earnings release or something that the market doesn't like, I might just quickly buy it back if I get stopped out. But it's there to protect me against a bear market. I did do a video on my portfolio construction, and I talked about this concept in there. So check that if you're interested. Now, competition is a risk. We're still on the risks here. So competition is a risk. We've really got to keep an eye on this. And specifically, it will show up in the TPV numbers and the market share numbers, right? So definitely worth watching. We have very competent competition in this space, but this isn't. I don't think this is a winner take all sector. It ends up being sort of an oligopoly type situation. So maybe a problem, might not be a problem. Worth keeping an eye on. Again, I mentioned the concentration, the revenue concentration. 10 customers make up 62%. Now that is, if there's two risks there, right? You lose a customer, you lose a huge amount of your revenue, but there's also risk that, the saying of, if you owe the bank $1 million, the bank owns you. If you owe the bank $1 billion, you own the bank, right? So this is one of the you own the bank situations where these big companies know that DLO needs them, right? So they can really press down on prices. Now it's a symbiotic relationship. DLO has a great offering for them, so they probably wouldn't want to press them too hard. But these are smart companies. They know they can press down on price, and they are going to. I don't know if this is a real issue, but in 2024, the management lost a little bit of credibility because they had targets and they dramatically underhit them for various short-term external reasons, right? And you'll see that in the chart. You'll see that's why it's down. But I think they're still in the process of rebuilding their credibility and not sort of getting ahead of themselves. The market thinks this one's a risk. I actually think this is a benefit. So stable coins are this, my understanding is that you can send money internationally very quickly and easily. You don't have to go through any of the normal routes. So you can send it any time of the day, almost instantly, like in seconds, right? And they facilitate just very easy cross-border transactions. And that's a threat to the cross-border side of DLO. But what are they doing? They're taking it on. They're starting to look into stablecoins. They've signed some contracts with stablecoin providers so they can actually be on this journey as well and offer this as a product. So they're taking what would have been a risk and turning it into potentially an asset, right? Because if somebody else doesn't offer this, then that gives them a leg up. All right, here's the numbers, and I'll do a little bit of a projection here. So the numbers, we'll just go through this quick. TPV was up 43% to 9.2 billion. That's even after a 12% currency headwind. So we're going to ignore the constant currency rate because that's irrelevant. What we care about is the net at the end of the day, which is 9.2 and 53%. Revenue's up 50%. Gross profits up 42%, right? So you can see that the gross profit margins under pressure. That's expected. And then the EBITDA is up. The gross profit to EBITDA rate is up to 70%, and again they expect that to go up to 75%, right? So net income was 53 million or 43 million. They actually had a write down for Argentine bonds based on that problem I was talking about, and without that it would have been 53 million. So I think that's a more relevant number for us. Free cash flow is quite good, 48 million, and they had 5 million in working capital changes. So if you're like me and you don't like the working capital numbers as part of free cash flow, then it's more like 53 million. And then they raised all the guidance. This was probably the reason for the pop in the stock. TPV will be up, midpoint is 45% this year, still growing extremely fast. Revenue up from 30 to 35 at midpoint. Gross profit up to 32.5 at midpoint, which would be 390 million for the year. Again, that's the number we want to watch, the gross profit. And then the EBITDA would be around 274 million, which again is up a huge amount. That the guidance is up huge there. So if we look at a valuation right now, EV is 4 billion, right? So EV to EBITDA is just under 15 at this moment. So not super cheap, considering it's in emerging markets, but if you compare it to the growth rate, it's pretty nice, right? If we're growing gross profit at, what was it, 40%? Oh no, sorry, 32%, and this is trading at 15, then you can see it's under 0.5 in terms of those peg numbers. Balance sheet's clean, 570 million in cash and in short-term investments, no debt. That's all I'm going to talk about there. And let's look at the models. Okay, so I apologize, this is a bit of a mess. I just kind of whipped it up. But basically the idea here is that in the first part, the left part, I've pulled the analyst projections up to 2027, and then I've just built in a moderate growth rate to 2030, where it says base and a lower multiple. And you can see the gross profit take rate is going down over time, and that's the compression I was talking about there. If this all works out, then gross margin at the end of the day would be 879 million, with EBITDA at 659 million. Now, it depends on what multiple you want to put on that. Base, I'm putting 14 on just because it's growing quickly. But if you use a 10, because it's a emerging market, you can see the IRR there is anywhere between 9.5 and 16.4. Now, I think these might be conservative, right? You see the growth rates are pretty low there after 2025, and I actually don't expect them to slow down that much. Let's look at this next one. So it's a 10%, I'm assuming a 10% growth in the TAM over the next 10 years. So this is 2035 now. And then the moonshot is 14% TAM growth to almost 8 trillion in 10 years. So it would be almost 5.5 trillion or 7.8 trillion on the moonshot. And in those scenarios, I've dropped the gross profit take rate a bit to 0.9 just to try and be safe. And I've put the gross margin down to 33%. Again, these could be actually lower, but I'm just trying to give a general idea of what's maybe the long-term potential here. Now, I won't spoil the fun for you, as Buffett says. If you're interested in this, I suggest you go figure out your own models and figure out what you think this is worth or where it's going. I do find this business quite difficult to project. Even the company has trouble projecting like the next 6 months because there's so much craziness going on with EMs. But I'm just looking at, is there a huge upside here available if I'm in this one? And I do think there's a possibility of something really big happening, right? So if you look at the gross margins on the mid, almost 2.5 billion or even 7 billion in the moonshot case, which is pretty crazy. So if we So if we go look at this mid and moonshot rate, the difference between them, if you look at the percent of TAM line there, I'm saying, okay, let's say they grow from 1.8% of TAM now to 5%. Let's say they're taking market share, like 5% of TAM. That's pretty reasonable, I think. And then on the moonshot, they're 10, again, possibly reasonable, right? And remember this, they're growing, but the market around them is growing super fast too, right? Because of this move away from cash, particularly. Now, again, I put a 12 multiple on one and 14 on the other, and you can see in the moonshot case, we could see 34% CAGR over 10 years, which would be very nice. Now, this isn't I don't think this is a no-brainer at this point, right? And that's why my position is a little bit smaller. I would have, if it goes down back down to 9 or 10, I think that's probably going to put it in the no-brainer category. But for now, I want it to be on the bus in case the bus leaves the station and never comes back, right? Because I really do like this business. I think it is a great business model and has the potential to be very sticky and very growthy for a very long time. The bottom line for me is the key things I'm going to look for, because you're going to get a lot of information on this one. The key thing I'm going to keep an eye on is the TPV growth. That needs to be high, even if earnings are bouncing around because of devaluations or whatever. TPV is the key one, right? And then, you know, are they growing fast and taking market share? Those are the key questions I'm going to look for as they report earnings going forward. And then I'm going to try and keep an eye on Adyen and Stripe, what they're doing, right? I think if those situations are okay, they're still growing fast on TPV and taking market share, Adyen and Stripe are not trying to destroy them, I think things should be fine. But in the meantime, it's, like I said, we're going to do this, right? And the final bottom line bit is this is a massive TAM. There's a lot of room for them to work with and grow and just do phenomenal things with this business. So we just need them to execute. I need them to execute and continue being the #1 player in this space for companies that want to go to emerging markets. All right, that is it. Long video. I appreciate it if you've made it this far, and thanks, and I'll catch you in the next video.